Hello everyone and welcome to this new episode of Learn Stress Free. I'm your host, Jeff Rodrigue. My goal with this podcast is to make scientific knowledge accessible to the public in a way that's fun and easy to understand for everyone, even your 5-year-old cousin. All thanks to my expert guests who conduct research in academia. In today's episode, we'll be discussing financial mathematics, machine learning, and actuarial science. Our guest is here to explain that financial mathematics is about much more than just numbers. Drawing on his expertise in extensive scientific research, our guest will explain what is machine learning, what is the role of actuaries, what are the practical applications of machine learning, not just in finance, but for the greater good. What role does the regulatory framework in the financial sector play, and why is it important for the use of machine learning? And I asked him a controversial question that he was kind enough to answer. To find out what it is, you'll have to listen until the end. That way, you'll get the answer to these questions and more. Without further ado, let's learn stress-free with Frédéric Godin from Concordia University. Hello everyone, and welcome to today's episode for science. So today, we learn stress-free because learning should be fun and should be stress-free. So before we begin, as you know, I want a podcast that is human. I really focus on the people. And so the science is great, but people are even greater. So before we talk about the science, let's meet the person behind the scientist. So Frédéric, welcome aboard. Who are you?
Welcome, Jeff. First, I want to thank you for inviting me to this podcast. It's a pleasure to exchange with you. So who am I? Well, I am a professor in the Mathematics and Statistics Department at Concordia University. My area of expertise is financial mathematics and actuarial science. So from a professional standpoint, this is what I'm doing. And as a hobby, I do like sports and music. So this is who I am like when I'm not in class.
And what brought you there? Because no one does a PhD because they're bored. You kind of need like a certain fire inside of you that needs to burn bright.
Yeah. So like when I was younger, I really enjoyed mathematics and I was very curious about that topic. So I wanted to do like studies in that area, but I also wanted a possible area of application. So I was a bit pragmatic and I thought I would need a job like after my studies. So I wanted to find a subfield where you had a more direct application than just theoretical mathematics. So actuarial science was one of these fields where you can marry business and mathematics. So this led me to study actuarial science, and eventually I bifurcated towards mathematical finance. So this is an interest I developed throughout the course of my studies. So and which like I saw mathematical finance involve quite a lot of mathematics, statistics, and other quantitative disciplines that I found very interesting. So this is how I came to study these topics.
Interesting. So before we dive in, what does an actuary does actually? Like, what do they eat in winter? What's like the daily life on an actuary?
So the role of an actuary is to participate in the management and do like some calculations within what we call financial security systems. So example of financial security systems are insurance companies, pension plans, government benefits plans. So these social security systems are systems that allow first to transfer risk from individuals to the society at large. So it's a form of pooling of risk. And there's also the role of redistribution of wealth that is partially tackled by these social security systems. So the idea is when there's risk, there's uncertainty, and actuaries, they do calculations to help manage their risk within these financial systems. So to ensure that financially the risk is well managed, and that everybody's eventually like safe.
So, for example, it's like when you go get an insurance submission and you know, okay, this is how it's going to cost me for my house insurance, for example. It's basically, the job is kind of analyzing the risk. So if my house burned down, the insurance covers, but the insurance kind of doesn't lose money because of the people who pay a premium
Yeah,
service without having their house burned down.
yeah, exactly. So when, like, let's take the example of an insurance company. The insurance company needs to do several things. First, they need to decide how much they're going to charge for the given risk. Second, how much capital they need to keep as a safety buffer in terms if worst case scenarios occur. And they also need to do what we call underwriting and selection of risks. So if some risks are not appropriate, they need to decline them, or if they are appropriate, they need to decide to accept them. So actuaries are involved in all these calculations. And for example, taking your fire insurance, so actuaries, like, they must decide, like, if they take some risk, how much it's going to cost them in average, and then they can add like a margin for profits, a margin for paying expenses of people in the insurance company, margin for risk, and then adding all these together is this consistent the premium they charge. So premium calculation is an example of a duty of actuaries, or another one is a safety buffer calculations.
So a lot of maths. So if anyone listening, if you don't love maths, maybe choose another career. But if you love maths,
Well,
you'll be happy.
actually, so maybe this is a misconception in a sense, because when you're studying at the university, you do a lot of mathematics. But as you delve into the field, as you become an actuary, there are several possible routes. So some of them become extremely proficient from a technical perspective. They do like stats, they do machine learning, they learn how to like estimate or handle complicated models. But some other actuaries are needed for their business acumen and ability of communication. So if you're, for example, doing consulting, then yes, you need to understand how like pension plans work, but you also need to be able to communicate with your client to make these things more easy to understand for customers, to explain things. So I think it's a very broad spectrum with very technical people and more, let's say, qualitative people that, yes, they need to be knowledgeable. But I don't want to convey that message that the actuarial profession is only for diehard math people. There's something for
For everyone.
yeah, for everyone. Well, maybe not everyone, but like many types of people.
Many kind of options. So you said you're an actuary, but you also study machine learning,
Yes.
as you mentioned a few moments ago. So first of all, what is machine learning? And second of all, how is it different from better known AI such as generative AI like ChatGPT?
That's a very interesting question. So my understanding is that artificial intelligence is a collection of methods that allows an entity, an agent, or a robot to perform some duties without being guided by a human. Machine learning is often understood as a subset of methods within artificial intelligence, where the ability to you gain like where the machine gains the ability to do some task through learning. So typically how learning is done is through gathering of experience. So often there's a large data set of that can be of interest, and machine learning digests the information in these data sets to become able to do a task. So the idea, artificial intelligence also incorporates other types of methods, which are where you don't necessarily learn, where you're told what to do to emulate a human, for instance. So artificial intelligence is a bit more global. The idea is to be able to do a task without human guidance, and machine learning is a subset of these methods where the ability to do that task is achieved or attained through learning from some data or from some experience.
And how do you structure machine learning? For example, like do you need to give them guidelines or a certain framework in which the machine will actually use the data, analyze it, and reach a certain objective?
Yes. So the idea is that the human, although like the human doesn't learn, he needs to specify to the machine an objective. So you say, machine, try to make these forecasts as precise as possible. So you have a data set and you need to make these forecasts as precise as possible, but you're not prescriptive on what these forecasts should be. So the algorithm has, the machine learning agent has a set of algorithm to be able to learn how to get to the this objective. So the human prescribes the objective, but then the machine learns by itself how to get to that objective.
So the objective had to be clearly defined, and I guess you have some parameters, probably like ethical or legal or certain frameworks that you basically tell the machine so it works in that framework.
Yeah, exactly. So you can specify ethical constraints or things the machine cannot do, for instance. But the idea is once you specify the goal and these constraints, so constraints are in some way part of the goal. Once you're giving this objective and these constraints, that you let the machine be free to learn to get to this goal in whatever way the machine deems fit, like within the algorithms that are given to it.
What's the difference between generative AI, such as ChatGPT? Is it about the framework or the objective, or how you frame the question, I guess, for the machine?
So there are many possible objectives. So one of them is, for instance, forecasting. Machine learning are very good at predicting or forecasting people. So for example, let's say you put a $5 bill in the ATM machine. It can forecast, like looking like computer vision, looking at the image, what is the digit? Is that $5, $1, or something like that? So this is an example. They call it regression, but we can call it forecasting. But another objective that you can give to the machine is to generate new data that looks either like some existing data or that matches some objectives. So generative AI, it's one possible task that you give to the AI machine, which is to generate new stuff. So if you ask him to write a poem, that's generating new data that matches some properties. So I'd say Gen AI is one possible AI objective amongst many.
How do actuarial science and machine learning coexist? Like how?
That's a very good question. So the idea is actuaries, they typically hold on to very large data sets. So if you work in an insurance company, you can have data about the various policy holders that are insured by the company, all of their characteristics. If you work in a bank, again, you have a lot of information from all your customers who have have subscribed to a loan. So there are huge data sets that need to be analyzed to convey information from these data sets. And machine learning methods are excellent methods to analyze extremely large data sets and observe patterns from these data. And the idea is that once you've observed pattern, often you can there's something actionable you can do. So, for example, if you find that one segment of the population typically has safer behavior, then you can charge less in terms of insurance premium. So the idea here is that often actuaries need to do some form of statistical analysis of data sets to extract some information, and machine learning methods are very good to extract patterns or extract information from very large data sets.
So it can basically do the work of many people in like a fraction of the time and resource, I guess.
Exactly. So for one instance is like you can think about is that there are many possible models you can apply to let's say predict the amount of claim from a policyholder. Where well you can automate this procedure through statistical or through machine learning calculation. So the machine learning methods or computers in general are very efficient to do tons of calculation, which couldn't be handled by a single human in a reasonable time frame.
For our listeners, if you're not familiar with statistics or you have bad PTSD from statistics at school and you just, try to delete that part in your brain, nope, never thinking about statistics ever again. My childhood friend is a statistician, and it's impressive what you can do and what you can understand through when you have a lot of data and you're allowed, to see how things interact with other things. It's pretty incredible. It can tell a story if you set the proper framework and you understand like how things are. He's much smarter than I am. He tried to teach me statistics and he lost respect for me when he tried to do that. But it's very, very impressive how it can help us understand things, actually.
And the idea is, under machine learning, there's very intense mathematical statistical concepts, but the reason why we are using this algorithm is we want to obtain often information that can be understood in a more simple manner. So we want more qualitative lessons sometimes that we obtain from very dry like data or quantitative like information. So sometimes it's a way to extract global information from a bunch of data that are scattered around. So like the you mentioned like statistical hardship and these things like that, but the utility of stats is basically take something complicated and have a simple conclusion from that.
Just like this podcast, we take complicated things and we try to make them as easy to understand as possible. The title of the episode mentions financial mathematics. It's more than just numbers. You mentioned to me in our preliminary meetings when we initially met, there are different aspects to consider in your field, such as structural and regulatory frameworks of financial institutions. And so, which begs the questions, what's the purpose of banks in society, and how do these regulatory framework impact the reality of actuaries and the use of machine learning?
So this question is twofold. So I'll kind of take one at a time.
Yeah, first.
The first is like, what's the
what's the purpose of banks in society?
So I'll take it like a step more general. And what is the use of the financial system? So the use of the financial system is to allocate capital, or basically resources, to activities that are the most efficient. Because like in the economy, there are many opportunities or possibilities to accomplish economic tasks. So maybe one company wants to dig a mine somewhere. Maybe one company wants to build cars. Another company wants to I don't know, like build a new building or something like that. So all these activities, they provide some economic benefits, and they're associated with some degree of economic risks. So the idea is that there's a finite amount of capital or resources that can be allocated. So the idea is banks, they look at all these opportunities and they allocate capital to activities that are most promising in terms of returns on your investment in terms of resources. So the global effect of the banking system or the financial system is that we try to pursue the most efficient economic activity. So that is the main purpose of the banking system. And why is there some regulatory framework? It's because like banks need to take some form of risk when they lend to people, and they have different lending practices. But we must make sure that these practices are not abusive and they don't lead to undue risk that can create difficulties for the society. So there's a regulatory framework in there. But we've talked about the banking side. We can also talk about the insurance side, where there's a strong like regulatory framework to ensure that the insurance underwriting process is ethical. So one example that we could discuss is in ethics is discrimination. So for instance, insurance is a discrimination activity. So you have several people that want to be insured and they all want like different rates or expect different rates, and you need to pick which one of these individuals you will insure. But in doing that, you must ensure that the way you decide is ethical. So you cannot discriminate based on, like, for example, ethnicity or something like that. That would be unethical. So
Yeah,
regulatory
just
frame. Yeah,
if I may just, so when you say discriminate, not discriminate in the sense of discrimination, but in the sense that basically you have to pick and choose in a way, like which customers maybe fit better your
yeah,
service offer and such. And then you want to make sure, because I understood what you meant because you use the term discrimination, but in a way it's not discrimination in a way that, it's unethical. It's just discrimination in the term
yeah,
that I have to choose who do I insure or not insure.
exactly.
And then the purpose of the framework is to make sure that the machine doesn't discriminate, as in discriminate per se.
Yeah.
So we want to make sure that doesn't happen.
Discrimination is a loaded term in the sense that it looks like you're harming somebody by discriminating. But discriminating, if you look at the definition, it means like choosing between like different opportunities. But there's discrimination and there's like ethical discrimination. So there are ways to discriminate that can be deemed ethical, acceptable. So for example, if some driver is reckless and some driver is more safe, it's fine to discriminate based on your driving habits, but you cannot discriminate on, let's say,
origin or skin color or whatever other criteria that are protected by the Charter of Human Rights and Freedom in Canada, but most countries also have their charter against discrimination.
Exactly. So these wouldn't be acceptable. So like you have some regulatory framework that prevents you to discriminate against that. Or like also like going back to the banking system, there's some regulation that prevents you from taking loans that are much too risky for you and that you're very unlikely to repay. So for instance, when you subscribe to a mortgage, you need to have a minimal cash down amount, and if you don't have this amount, you need to subscribe to some mortgage insurance, because we want to avoid placing people in very risky financial positions that will lead them to or possibly lead them to financial hardship. So this is the role of the regulatory framework. It's to basically, the idea is that we want to protect people against adverse or unfair outcomes.
And sometimes I like spending. So sometimes it's going to be good to protect me from myself in that kind of case. So basically, so the framework is the rules in a way that you give to the machine. So it's the framework in which the machine will use the information to then provide either, I guess, a loans decision or insurance premium and such. Because insurance, I remember, I don't know if it's still like that because I haven't been 25 years old for a while. But I remember when I was younger, I mean, being under 25 was considered at risk because, well, you have less experience or more reckless drivers, higher chances, of getting speeding tickets and such. And then eventually, and so insurance company back then, like when you reach 25, you're like your insurance. If you have a good, if you drove safely and didn't have too much speeding ticket, if your file was clean at 25, you got a good rebate because then they consider you less risky. So that's basically the analysis that they did back then. I don't know now.
But yeah, I think that's if you could do it either through machine learning or conventional statistical techniques. But the idea is that if at a certain age you're charged less, it's because the data has spoken in some way. So when you did the statistical or machine learning analysis, you realized that there's a pattern where at a certain age, there are less policyholders that are filing claims, and that as such you can like decrease the premium. So it's like basically when we said like you need to convey simple conclusions from complex data, this is an example where you see the data speaks to you and then you conclude that at a certain age, if you're a good driver, then you can possibly decrease the premium because people are take less risk.
If I'm not mistaken, like for example, where you live, not in the sense of discriminatory, but in the sense of like, is there a lot of accidents in your area? Is there a lot of car theft in your area also to evaluate? If you want to be covered for car theft, but your area is where there's the most cars stolen, like statistically, you're more likely to get your car stolen. So it's more risky for us to cover that. It's kind of what we see also, I guess, for housing insurance. Because I know now because of climate change, flooding, tornadoes, like we see more and more of those. So insurance companies to kind of make their investment worthwhile, and also to be able to have the financial resources to support their clients, they're also raising their premiums.
Well, yeah, because the idea is if there's higher risk, but you don't raise the premium correspondingly, then the financial company would be more at risk of financial distress or even go bankrupt. So the idea is when there's more risk, premiums must be adapted as such. And right now, you talked about global warming or climate crisis. Well, there's a very large effort in modeling, for example, droughts and fires and tornadoes and all these climatic events, because it's very important for insurers to understand where these risks are the most severe and understand where you need to charge more for some risk.
It's kind of a way to share the responsibility in a way with clients. I mean, so if my house burned down, like the company has money to pay me, your house doesn't burn down, but you still pay a premium in case, well, yours burns down. So it's kind of a way of it evens out, I guess, not at the end of the day, but at the end of the year, or to be able to have basically a sustainable model that allows to provide coverage for the clients.
And it also incentivizes, for example, if in some regions you're more likely to have floods or earthquakes, then you'll have less developers building new homes in these areas. So it's a way to incentivize people to take economic actions that leads to less risk in some sense. So
build different, build somewhere else.
Yeah, as an example. But of course, sometimes your house is located near the seashore. Yeah, so there's not much to do. So sometimes it's the government that, if there's no insurer that is willing to protect against these risks, the government could help filling this gap in the market by either providing insurance or maybe subsidizing insurance for these cases where you're kind of stuck there and there's not much you can do.
But they'll also do their risk analysis, I'm guessing. So it's
yeah, well, the government hires actuaries too. So whoever does it, you need some risk reward analysis to understand what's the pricing you should use and etc.
For people in our audience, what are the impact of these new machine learning processes, like in concrete terms? How can it impact them on a daily basis? Like, do we start seeing more and more how it impacts us, or what's to expect of how machine learning is going to transform our either day-to-day life or things we interact with pretty frequently?
I think we're already seeing some impact in the sense that this machine learning methods allow us to gain substantial efficiency in many areas. So let's say you want to subscribe to an insurance policy 100 years, well, maybe not 100, but let's say 50 years ago, you would need to ask each different company for a quote, and in each company you would have a human employee that goes through all your characteristics and provides you, based on this, here should be the quote, etc. So it's substantial efforts, takes a lot of time, and all these people, they need to be paid, so additional costs. So by streamlining this process and having a machine propose a quote, you can get information much quicker at less costs, and having less costs allows you to be more competitive and reduce your premium in some sense. So this is from an insurance perspective, but there are many activities. Let's say when you go to the ATM, the cash deposit, and you give your $5. If you need a person to check every single one of your bills, then it takes a lot of time versus when you just have a digit recognition machine, it saves a lot of time. And we're seeing like, or for example, ChatGPT, when you want to do a literature review or to like gather information about a topic, nowadays it becomes like much more simple to get access to high quality information because these new tools that have emerged, they allow you to gain a lot of efficiency. They're much faster and they allow you to save a lot of time. So I think we're already seeing the impact of machine learning and many aspects of our life.
I think also I hear a lot about medical field, and so I
Yeah.
heard like from some people who do research in medical fields, like the power of the machine to analyze data can actually help us. Like maybe there's some tiny things here and there that doctor misses, like here and there, but actually the machine can take all this information and says, well, the little thing that everybody ignores is actually very relevant for one specific disease, for example. So they say it could help even diagnose the disease and be more in a proactive kind of medical approach also to disease. Is that kind of thing that people might see in the near future?
Well, yeah, I think it's even in the present, not even in the near future. So the idea is if you're a doctor, let's say you can see, I don't know, 10 scans in a given day, and then you work like 250 days per year and you have a career of 30 years. So like you can only see up to a certain fixed amount of data through the entire career versus if you're a machine learning algorithms, you have the possibility to get access to much more experience if you can like go through all these images from all these tumors. So I think machine learning methods, because they're able to convey a very large body of experience, they can provide very efficient recommendations that can accompany recommendations from the doctor. So at this stage, sometimes the technology is not 100% trustworthy. So, for example, we were speaking about Chat GPT. We know about like hallucinations, where sometimes you cannot fully trust the ML machine learning algorithm, or self-driving cars. We had accidents or things like that. So we cannot blindly trust this technology at this stage, but I think it's of tremendous help to help your decision making and gather access to large body of information with very limited effort. So it not only, I think it allows to speed up many duties, but sometimes you have better performance because you can supplement your information base throughout the use of machine learning.
And instead, the like basically the machines is not to a point where we can trust it blindly. For sure, I grew up watching Terminator. So if like me, you saw that movie, like, I have not the biggest fan necessarily of all those things. If you're younger and you've ever seen the movie, definitely worth a watch. Maybe wait till school is over, because focus on school first. But because you mentioned like it helps. So nothing's perfect, but I guess what are the advantages and disadvantages of the learning decisions that have been made, and what's the impact of to make sure that humans are still involved, and what's the impact of having decisions where we might eventually see humans not involved anymore?
Well, I think there are ethical issues to consider. So, for one example, is warfare, where like if we use like weapons that only operate or that operate without any human guidance, weapons they can they could decide to kill people without a human saying yes or no. This becomes problematic because
Like they could target things like like this. Oh, statistically, this is the biggest target. You're like, yeah, no, don't do that. Don't do that. Because
exactly,
still in war, there's still kind of ish rules. If we, oh, anyway, that's a whole other topic. But even in war, kind of rules, if I may, air quotes. So I'd like to say, yeah, maybe like statistically, it's the best thing, but the rules don't say that you can do that.
but there's two things. There's the ethical component and the error component. So sometimes if you, for example, you think it's a enemy fighter and it happens to be just a children playing there and the machine makes an error, then the outcome is terrible. But also killing is just like a very difficult ethical problem, and you don't want to give that full control to the machine. I think they're like probably you need a human in the loop.
Machines are basically zero and ones, right? So it's very, very objective at how it looks at things, but humans are like, yeah, no, you can't do that. Like, we don't care about the objectivity here. You just can't do that. But the machine will probably, hopefully, never learn that in a way, because if it does, then we're all going to be replaced, I guess. We're all going to be useless. Then it's a Matrix, another very good movie. But I should become a movie critic. Maybe I should do another podcast. So we see that even though the machine get more powerful, it's basically a very good helpers for decision makers or for professional, for a human at the end of the day. Like we talk about doctors, we talk about actuaries. So having access to so much information that your brain just could probably never compute in your lifetime, and then be able to have so much good information to make a decision that is better informed probably than it would have if it was just like you and me trying our best with our limited brains versus the machine who's like, here's all the data from the world's history.
So I think as humans, we need to be aware of our cognitive limitations, and machines for some duties are very good and much better than humans. So for example, just doing like computations, like machines are much more efficient than regular humans. So using machine learning as complement is just it allows us to benefit from both the strength of machines and strength of humans and combine them.
Take the best of both worlds.
Exactly.
That was cute. I have my cheesy moments.
Oh, wonderful.
I was not following the news that much during the American banking crisis of 2008. Maybe there's some people who were listening to that podcast was like, I wasn't even born in 2008. But there was a big economic banking crisis in 2008. And so what can explain what happened in the US versus the Canada, which, you know, being so close to the United States, and, you know, when they get a cold, we sneeze. So, but from my memory, we didn't get hit as hard. Can the regulation you mentioned earlier and the risk management be part of why what happened?
Well, so I think, again, there's two aspects to discuss. First is what caused the crisis in the US and what differentiates the Canadian situation and the US situation. So what caused the crisis? I think this can be a very long topic that can be discussed at length. So like we can do a very high level
what the short ChatGPT version.
Exactly, in a few sentences. And the idea is that there has been a very aggressive risk taking in the banking systems for mortgage loans. So a lot of people were able to take very risky or aggressive loans because banking were starting to develop a new technology called securitization, where they could take these loans, which are very, very risky, package them together, and sell them to somebody else. So they thought they would be able to take the loans and get rid of these very toxic risks and let the financial market absorb this risk.
They thought they found a cheat code, like a loophole. They're like, oh, we found something that works, miracle.
So I'm not sure if it's they thought it was a miracle, but they thought it would help to offset risk. And by offsetting, if you're able to better offset risk, you can be a bit more aggressive and take some more risk. But the idea is like these new securities that were sold to the market, like the investors probably they weren't fully aware of the risk they were taking, and the rating agencies they didn't perform their duties well. So some of these products were very high risk, but they were rated like AA, AAA, or something like that. And there's probably also a portion of just greed and lending practices. So
we never do that.
So some people, like for example, if you're a portfolio manager, probably your bonus is just dependent on what's going to happen in the next year. But the worst case, like if you do well, you get $1 million, and if you do poorly, then you just get fired. But like you can find another job somewhere else. So sometimes the probably their risk management oversight was not done properly, And the banking system, it's very complex. So sometimes it's not necessarily like dishonest behavior. It's just very complicated systems to oversee and manage. So basically, in a nutshell, a lot of aggressive mortgage risk taking. Plus, this this led to a housing bubble. So house prices in some areas of the U.S. they just skyrocketed, and when the bubble burst, suddenly a lot of people weren't able to reimburse their loans. This created losses for these financial institutions that were very aggressive. And the idea is the financial system is very highly tangled together. So like all banks, they lease to all other banks or borrow from all other banks. So when Lehman Brothers, so this is one large investment bank in the US, when it collapsed due to, again, like losing some money, all other banks suddenly who were borrowing or lending money to Lehman Brothers, they thought, okay, I won't be able to get my money back, but all other banks won't be able to. So all other banks suddenly become at risk. So everybody thinks everybody else is at risk of like financial distress or even bankruptcy. So all banks stop lending to each other, and the capital becomes very hard to access. So if you're a company and no bank wants to lend money to you, then sometimes you need to stop doing business and then fire all your employees, and this leads to a recession and more problems for the economy. So this is story short, like if we want to do a short story, how to explain what happened.
Considering what happened in the States, how did we get lucky in Canada? It's just the structure of how things are here that helped us.
Yeah, that's a very good question. I think in Canada we handled better the financial crisis because of several reasons. So first, the regulation on banks is a bit more stringent in Canada. So banks, first, they need to hold a higher capital buffer. Also, there had been like more strict lending practices, and like the securitization process where banks want to get rid of these toxic loans. This innovation was not as present in the Canadian banking system. So because of that, Canadian banks couldn't be as aggressive in terms of lending practices. So like higher regulatory oversight, higher like capital requirements, less exposure to like these financial innovations, which turned out to do not so well. And there wasn't an acute like housing price bubble in Canada as
I
in the
miss those
US.
days. I miss those days so much. If you're Canadian and you're listening to the podcast, you probably miss those days too.
And not even Canadian, I think in the US too.
Yeah, it's pretty the
It's
housing bubble. It's the worldwide crisis. So you're telling me regulations are good?
yes, well, good and bad. So
Oh,
it
it depends.
depends.
Yeah.
So too much regulation can cause problems, and too little regulation can also cause problems. So in this crisis, I think too little regulation was a problem, but regulation has costs. So for instance, let's consider more stringent requirements in terms of capital. So when things go badly or go south, I think we're very happy that banks hold more capital. But when things go well, holding some capital is costly, because instead of keeping that capital, if that capital was used somewhere else in the economy, that could create economic benefit. So the banks who are holding the capital, they need to pay investors who are like giving them this capital, and more costs mean this cost is reflected in services that are offered to you. So services are probably more expensive, more costly because of this higher regulation. So I think in regulation there's a trade-off where if you ask for too much buffer, then things become more too costly, but too little buffer, then there's a lot of risk. So knowing what's the right amount of buffer is not an easy question.
Well, it's like basically at the individual level also. Like if you keep all your money in your bank account, if there's a crisis, then the stock market crash, because I don't know exactly the day the episode will be published, but we're in the midst of headlines being about tariffs. Yes, no, maybe we'll see, maybe yes, maybe not. So if you have your money in your bank account and you're not making much return on investment, and if things crash, well, your money's in your bank account. But if things go well and the stock market goes up and your money's in your bank account, well, it's like, well, oh, okay, well, I missed that. I guess maybe next time.
So it's all about risk reward trade-offs, and in the financial area, a lot of tasks involve optimizing risk return trade-offs. So
So
this
trying
is
to find the balance that probably changes based on many things from the environment and political, economical landscape also.
Exactly.
So a lot of challenge in your field. If there are people listening and like, oh, I want to do post-grad studies maybe, or I want to go to university, I'm not sure which field. Seems like a field you won't get bored in.
Well, absolutely. I think there are a lot of interesting challenges in either finance, financial mathematics, actuarial science, machine learning. So all these areas will undergo interesting and important developments to tackle novel challenges. And the idea is every time there's a crisis, we kind of learn something new about the system because the financial system becomes more and more complex. So, for example, all these financial derivatives are becoming increasingly complicated. Trading becomes increasingly complicated in some sense. So, all this layer of complexity sometimes it allows the system to be more efficient, but there are risks that we don't necessarily understand until they hit. So, the field will undergo very interesting developments. And there's also the question of sustainability. So now we're facing a climatic crisis, and I think definitely finance can help partially to offset this crisis if they start adopting a sustainable practice in investment. So there's movements of decarbonation of portfolios where investors they want to fund less carbon intensive activities. So this is sustainable finance. Green finance is a growing area and finance or mathematical finance. So if you're interested in that field, I think there will be many challenges in the coming years.
Yeah, climate and sustainability, big challenges we have now and facing in the years ahead. So definitely very relevant.
Interesting. And maybe another thing is like I think machine learning and finance are different fields. So there's a lot of ML experts, there's a lot of finance experts, but more and more we're looking to train some people to gain exposure to both fields at the same time to kind of bridge gaps between these two fields and transfer knowledge from machine learning to finance to help better tackle financial problems with novel techniques. So this idea of hybrid training and multifaceted training, I think, will be very important in coming years.
Nice. Are you ready for the next one? It's a curveball. I'm telling you right away, it's controversial, but I like controversial stuff. You know, we need to sometimes challenge things a little bit. So, full disclosure, I confessed I'm an idealist, right? I believe in unicorns and a perfect world and all of that. So I try not to watch the news too much. I'm not the biggest fan of capitalism or the banking system, but I often ask myself, why aren't banks nationalized? Why are banks private so they benefit the shareholders and not like public entities which could maybe return the money back to the people? Like I said, I'm a dreamer. I don't know much about all of that. So I probably have a very biased standpoint, but I want to get a better understanding of. Pretty sure there's a logical reason behind it. So that's why I'm asking, like, why are they privatized and not public so that basically the profit of the bank goes back to the people?
So I'd say there are many reasons for that. The first is risk taking. So like in good years when banks do well, you could think, okay, maybe these profits could benefit the society. But in bad years, when companies they undergo through financial hardship, then this would be a cost towards society. So you don't want, for example, if the government holds a bank in its portfolio of assets, then in bad years you don't want to be forced to stop paying teachers and doctors just because bank was too aggressive in its like mortgage portfolio or something like that. So companies, private companies, and the various areas of the economy, not only finance but in general, they often need to take some risk and to grow basically and to try new things. So the innovation process involves taking some risks. So to create new things, sometimes it works, sometimes it doesn't. But you don't want a situation where every time you're taking some risk and it doesn't work, that the entire society has to directly pay for it, because the purpose of the government is to like fund schools, fund hospitals, etc. And you don't want this funding to be contingent on the good performance of activities that are not necessarily associated with the government mission. And about, for example, we did it with Hydro Quebec in Quebec, where like the energy production activity has been nationalized. So I'm not saying it's not possible, but this would create a lot of risk in bad years that would be like borne by the whole population. So I don't think it's a good idea. Second, if we wanted to nationalize all banks, that would be extremely costly. So with what money would we purchase these banks? We need to
Good point. Good point. I haven't
have
thought of that. Yeah. They're worth a
very big
lot. If you want to buy something that's expensive, you need to pay a lot.
Yeah. So, and if banks don't do as good as you think they will do, or they do badly in the next few years, and you can't reimburse these loans with the dividends of your companies, then what are you gonna do? That might jeopardize again, like social programs. And the other idea is the other thing is the idea of competition. So right now in the banking systems, there are several banks. They're all in competition, and they need to offer services at a decent price. Otherwise, customers will just go to the competitor. But when you nationalize stuff, suddenly the idea of competition vanishes, because there's only one provider of the service. So you kind of lose an incentive to be efficient. And similarly, when you hold something, when you own something, you want to maximize the value of what you're owning. So this is when you have private property, this fosters incentives of being productive, being effective with what you own. Versus when it's held by the government, sometimes these incentives aren't that strong, and the incentive of performance or efficiency, it might not be present, especially in absence of competition. So for all of these reasons, I think there would be tremendous risk in nationalizing banks in our economy.
So because the pressure are not the same, the purpose, the missions are not the same. Okay, so I have to review my position on the topic then, with in light of this new information. Maybe they're not as bad as I think they are.
That's good. That's good.
But it's and it's true, because basically they don't have the same purposes, don't have the same mission, they don't have the same things to focus on either. And I'm pretty sure, well, we see it pretty much everywhere when governments take risk with a company or something like that. I mean, in Quebec, we just had this experience quite recently, but no matter where you're listening from, I'm pretty sure your government tried something and they missed, and, they paid a price for it for a very long time, and people remember and people stay angry about that.
Yeah.
Versus banks that is like, well, the shareholders might replace you, but, it's different world, if I may, like different environment.
Yeah, and different objectives. And again, the main mission of the government, like at least in Quebec, we have a strong welfare coverage, and we don't want this to be jeopardized through other activities that might not go as well as planned.
Yeah, we're pretty lucky actually here as far as social services that we have. We have help, like if you're bad on your luck, well, at least there's some support to get you back on your feet.
Life is good in Quebec.
Yeah. Winter is cold. Habs may make the playoffs. I mean, so if the Habs make the playoffs, it's probably going to be an amazing spring, because like the city is just crazy during that time. So taking my inspiration from the section of a science article. So if you go back to our episode 1, we talk about what's the scientific process. Mm-hmm. And one of the things when you read the science paper is, future research to be considered to add to the current research. So based on that, What are the current and future avenues of research in your field, and what can we expect from you and your research, if you're allowed to talk about it?
So there, I think in my field there are, and I think we touch a bit upon these, but very important trends. So right now, the use of machine learning within finance, within actuarial science, within insurance, it's embryonic. So it's just starting. But more and more, we want to understand how to integrate these technologies into financial decision making, into like actuarial decision making to improve financial outcomes, become more efficient at managing our risks, and yes, maybe be more getting more profitable. So, like the integration of machine learning into these fields is a very important trend right now. And there's this like we discussed, sustainability trend. So, if we want like finance to be viable over the long run, we need to make sure like our planet is not in jeopardy. So integrating all these sustainability concerns within financial decision making, financial allocation is very important. And right now, I think there's a lot of development in this field, but we're not yet too sure how to do that. So there has been like attempts at using like ESG. I'm not sure if you're familiar with that: environment, society, and governance. So ESG, yeah. So basically,
Corporate social responsibility?
yeah. So basically, you can score the various companies in terms of their performance for like from the environment standpoint, their social responsibility standpoints, and governance adequacy. But these are kind of subjective. So there has been a lot of backlash because it's very hard to evaluate from objective standpoint. Like, do you have good governance or bad governance? This is very subjective in some sense. So, but it's very important, but it's subjective. So right now we need to find ways to make this evaluation and such decision making more objective. So when we rate companies in terms of like, are they a good corporate citizen or do they do well environmentally? We need to formalize procedures to evaluate these matters. So I think this topic will become very important in coming years, especially in relation with the financial crisis. So that there probably will be a lot of efforts in the field of green finance, responsible finance, ethical finance, etc. So I hope I can contribute to these fields in terms of personal research. I use a technique called reinforcement learning, which
Like
is
Pavlov's
based,
dog?
well,
With the steak and the ring, the bell? But
yeah,
for computers?
yeah, well, you can in some way. So basically, reinforcement learning is sophisticated trial and error to achieve some goal that is attained over multiple periods. So let's say you play chess, you have multiple actions, all of which interact with each other. So if you play that piece on one of your turn, then this impacts the rest of the game. So reinforcement learning techniques, they are helpful to optimize multi period decision making where all of your decisions are interrelated. So I kind of use that to this machine learning technique to improve risk management of financial portfolios. So this I expect to do more research on that. More recently, I had like one paper with a postdoc and a PhD student where we optimized the risk reward financial trade off of a portfolio but with carbon emission constraints or carbon emission aversion. So you want the portfolio not only to give good risk reward performance, but to be as ecologically responsible as possible. So this project I enjoyed a lot, and hopefully I can continue working on that in the coming years.
I'll give a read to your paper. Hopefully, I'll understand it. Hopefully,
Sure.
I'll
Well,
understand it.
we can discuss that if you want.
I have a question for you. Maybe it just popped in my mind because on my free time and my hobby, I'm a gamer. Not as much as I
Okay.
used when I was younger because, well, I don't have as much time as I did. But
Yeah.
is this the kind of thing, reinforcement of the machine? Is it going to change how games can be made or how we interact in video games?
Well, yes.
Because I'm curious. And I'm like,
one
yeah.
of the very first test cases for these reinforcement learning methods are Atari games. So they developed a lot of
Whoa,
reinforcement learning
that's
algorithm
a long
by
time ago.
yeah, but the technology was tested like a few years ago, and now they develop neural networks reinforcement models that can beat like most of Atari games with a much higher performance than human. But this was one of the first examples because again, playing an Atari game like it's not costly versus if you need to optimize using heavy machinery and things like that or like an expensive robot, it's hard to do. But Atari games are a very cheap way to train or develop new algorithms to tackle these decision making. So Atari games were very helpful to develop reinforcement learning methods. And a lot of this happened in Canada, for example, in Edmonton or in Alberta, there's an important reinforcement learning lab. So a lot of these methods were developed in Canada.
Nice. I can't wait. I remember playing Atari with my dad like a long time ago. we came a long way since. We came a long way since.
Actually, like in my reinforcement learning class I teach, there was a few years ago a team of 4 students who like created a Mario game in R. So I don't know if you know the R software, but it's like a bit like Python, like statistical software. And they created an R Super Mario Bros. Level, and they had to teach how.
Copyright. It wasn't Super Mario. It was inspired by Super Mario.
Yeah, it was inspired.
A platform game.
Yeah, exactly. So we didn't steal any copyright.
No, that's for sure. You
But
know, they're watching.
they allowed the person to be the level. So I thought this was quite an interesting project. So it's a nice showcase of what you can do with these.
That's amazing. The gamer in me just got so excited. Well, on behalf of myself and the audience, I'd like to thank you very much, Frédéric, for your time, your expertise. It was very fun to learn stress-free about financial mathematics. Before I transition to the outro and my messages to the audience, I'll leave you with the final word for the episode. What would you like to say to our audience?
Well, first, I want to thank you, Jeff, for inviting me to this podcast. I think this was a very interesting discussion. And to the audience, yeah, if ever you're interested by these topics, I think there will, this we discussed, but there will be a lot of interesting challenges in finance, sustainable finance, machine learning applications to finance coming in the next decades or in coming years. So I think it should be a very exciting topic with a lot of developments in coming years.
Amazing. Thank you very much.
Thanks to you
for your presence. Have a wonderful day to you and to my audience, and see you next episode.
Yeah, sure. So have a nice day, and thanks again for inviting me.
Thank you so much for listening to our whole episode. I hope you learned a lot and had as much fun as we did. If you want notifications for new episodes, you can subscribe to my channel on YouTube or on your favorite podcast streaming platform. You can also like, comment, share with your friends and family on top of subscribing. It's a great way to support the podcast free of charge, allowing me to bring you even more subjects to learn stress-free about. You may also join my Patreon and follow me on social medias to get news and teasers for upcoming episodes. All relevant links are in the description below. I'm curious, what have you learned in this episode, or what surprised you? Leave us a comment and let's keep the conversation going. To conclude, a huge thank you to you, the listeners, and to our guests. You all make that podcast possible. See you soon for another episode of Learn Stress Free. Until then, keep learning. I'm your host, Jeff Rodrigue, signing out, wishing you the best. I love you all.